Have you ever wanted to see what the total market return FSKAX fund compares against the alternatives? In the vast universe of investment opportunities, it's critical to grasp the details of the various funds you might consider for your portfolio. Let's take a moment to briefly introduce three such funds: the FSKAX Fidelity Total Market Index, the Fidelity 500 Index, and the Vanguard Information Technology ETF. Each of these funds has its own unique characteristics, performance metrics, and risk profiles. The FSKAX Fidelity Total Market Index is a comprehensive fund encompassing a wide spectrum of the market. The Fidelity 500 Index, on the other hand, focuses on the largest U.S. companies. Meanwhile, the Vanguard Information Technology ETF zeroes in on the tech sector, offering a more targeted investment strategy. In today's discussion, we'll delve into the performance, risk, and cost of these three funds. Understanding these elements could significantly enhance your investment strategy and potentially boost your returns. The performance of an investment fund is a key factor in making an informed decision. Let's dive into the performance comparison of three funds: FSKAX, FXAI, and VGT. FSKAX, the Fidelity Total Market Index, shows a compound annual growth rate, or CAGR, of 13.91%. Its best year saw a rise of 33.42%, while its worst year dipped to negative 19.51%. Moving on to the Fidelity 500 Index, or FXAI, it shows a slightly higher CAGR of 14.36%. However, its best year was not as strong as FSKAX, at 32.37%. Nevertheless, its worst year was slightly less devastating, at negative 18.13%. Finally, the Vanguard Information Technology ETF, or VGT, stands out with a whopping CAGR of 20.43%. Its best year was phenomenal, with a rise of 52.65%. However, its worst year was a significant drop of negative 29.70%. But even at the lowest point of the drawdown, was still higher than the highest high of both the S&P 500 fund and FSKAX when you look at the numbers. The market correlation of FSKAX and FXAI is 1, indicating that these funds move in lockstep with the market. Meanwhile, VGT has a slightly lower correlation of 0.91, suggesting a bit more independence from the overall market. As we can see, performance varies across these funds, each offering different levels of returns. Understanding these variations is crucial in building a portfolio that aligns with your risk tolerance and investment goals. Risk and cost are two other crucial factors to consider in your investment decisions. When we look at standard deviation, a measure of volatility, the Fidelity Total Market Index, Fidelity 500 Index, and the Vanguard Information Technology ETF show figures of 14.82%, 14.36%, and 18.26% respectively. This means that Vanguard's ETF is the most volatile of the three. Now let's consider maximum drawdown, which reflects the biggest single drop from peak to bottom in the value of a portfolio. Here, the Vanguard ETF again shows the highest figure at minus 32.52%, followed by the Total Market Index at minus 24.90%, and the 500 Index at minus 23.88%. Next, we have the Sharpe and Sortino ratios, which measure risk-adjusted returns. A higher value in both ratios indicates better risk-adjusted performance. The Vanguard ETF leads with a Sharpe ratio of 1.06 and a Sortino ratio of 1.81, compared to 0.88 and 1.39 for the Total Market Index, and 0.93 and 1.48 for the 500 Index. Finally, let's examine the expense ratios. The Vanguard ETF has an expense ratio of 0.10%, while the Total Market and 500 Index funds have notably lower ratios of 0.015%. This difference in expense ratios may seem small, but it can significantly impact the cost of owning these funds over time. These metrics provide a comprehensive view of the risk and cost associated with each fund. Diversification and opportunity cost are two key concepts in investment strategy. Let's take a dive into these crucial ideas. Diversification, in essence, is a risk management strategy that mixes a wide variety of investments within a portfolio. It's like not putting all your eggs in one basket. It shields you from total loss, but with enough diversification, you can focus on a growth strategy, and the returns will compound over time that might even outstrip the total return of the competition, even during a drawdown. Now let's talk about opportunity cost. It's essentially the potential gain you miss out on when choosing one investment over another. Even if a fund has a lower drawdown than another, if its overall returns are significantly greater, it could still be worth the risk. Even at its lowest point, the potential gains could outweigh the temporary downward volatility. Sometimes it's not about comparing the peak to trough of one single fund but to the alternatives, then judging if you are better off. Understanding these concepts is vital when deciding on the best fund for your investment objectives. We've covered a lot of ground today. Let's summarize the key points. Our comparison revealed that the Fidelity Total Market Index, FSKAX, while offering a solid compound annual growth rate of nearly 14%, has displayed greater downside volatility than its counterparts, the Fidelity 500 Index and the Vanguard Information Technology ETF. More so, it doesn't offer as much upside return. The Vanguard Technology ETF, despite its higher standard deviation, has outperformed both FSKAX and the Fidelity 500 Index in terms of final balance and compound annual growth rate. The lower expense ratio of the Vanguard ETF also makes it a cost-effective option. We also delved into the concept of diversification, a safety net against total catastrophic loss, and the idea of opportunity cost. Even if a fund has a lower drawdown, if the overall returns are significantly greater, it could be worth the risk. Remember to subscribe and comment on what funds you would like me to compare next. Remember, an informed investment decision is a wise investment decision. Always consider performance, risk, and cost when choosing your investment funds.